In this week's video, we're going to have a look at recent employment and wage growth trends in Australia, and then we're going to turn our attention to the US yield curve, where we've seen quite a significant flattening this year, and consider some of the implications of that. First, to look at employment growth in the Australian economy. So the table here is just ranking the share of each industry of total employment. And you can see there healthcare has the largest share, healthcare and social assistance at about 13%, followed by retail, trade, construction, professional, scientific and technical, and education and training. What is probably more interesting is to look at how these have changed over time. And here now we're going back to 2007 and looking at the share of healthcare and social assistance as a percentage of total employment. So it's gone from around about 10.5%, as we said, to about 13.3. If we just have a quick look at some of the other sectors, in particular retail trade has declined from around about 11.5% to just over 10%. Construction, it's been one of those, it's been fairly steady, a very significant sector nevertheless, and has seen some recent strength, as you can see there, the gold line. Technical, professional, scientific will be the next one, and that is here. That's the green line, so you can see that steadily increased from 7 to around about 8%. Education and training, of course, is another important sector that's come in as the purple. And then interesting to look at what's happened to manufacturing. So manufacturing is the light purple line. You can see that that's declined from around about 10% to a little bit over 7% now. So there's been considerable changes in the sources of employment. And that is also reflected when we look at wages growth. So in this particular chart, we're going to look at, once again, we're looking at now annualized 3-year employment growth by industry sector, and the size of the sector in terms of the overall economy. So healthcare, as we saw before, 13.5%. Annual employment growth over the past 3 years of somewhere around about 6%. Construction's been strong, another big sector. Likewise, education, accommodation, professional, scientific. So you've seen strong growth in what are the big sectors really in the Australian economy. What about for wages growth? If we now flip this over and now look at annualized wages growth over the past 3 years by sector, and in fact this is probably a better way of looking at it, is where employment growth has been the strongest, and that's down on the X scale, and this is annualized 3-year wages growth. Once again, healthcare, education, training, arts, accommodation, food services. So as typically one might expect, the strongest employment growth areas have seen the strongest wages growth, and these are industries that are typically not overly cyclical and therefore don't sort of have the very high wages growth numbers. You can see down the other end of the table or of the chart, mining, real estate and hiring, admin and support and wholesale trade being quite weak. There's been quite a bit of discussion over recent weeks about the flattening of the US yield curve. In the chart here, we're looking at the 10-year minus the 2-year, and you can see this is on the right-hand scale. You can see that the curve has flattened quite sharply, with 10-year bond yields remaining around about that 2.3, 2.4% level, while the 2-year continues to build in the prospect of a tightening Fed. So that curve now has flattened in to around about 60 basis points, which is basically the lowest we've seen since sort of 2007, 2008. On the chart here, we've got shaded the areas where the curve has gone negative, and you can see those going back to the late 1970s. So let's have a look at some of the implications of a flattening yield curve. So first, on the right-hand scale, we've got the yield curve. We've got a zero line, and the red line on the right, on the left-hand panel, is GDP growth, and we've got shaded out the periods as defined as US recession. So, as it's been said many times before, the flattening yield curve through that zero level has often been associated with an imminent recession. We can see that in 2006 through to 2008, again to 2000. Certainly in the late 80s, early 90s, and then also in the early 80s period. So a curve that moves flat to inverse has often been a good indicator of a potential US recession. But the US yield curve does not tend to go flat to inverse until such time as the US begins to operate above capacity or above potential growth. And now the red line on the left-hand panel on this occasion shows the output gap in the US. So, and the shaded areas are the periods where the US is operating above its potential. So we can see here, once again in 2006, 2008, and the curve was inverted at that time. Likewise, 98 through to 2000, 2001, once again in the late 80s, and then we go back. So a precursor to a flat to inverted yield curve has often been the US economy operating above potential. Now, to put that into context right now, the projection is, and these are using the CBO numbers, is that the US economy, if not at potential now, will be over the next 12 months. So will we see a flat to inverted yield curve over the next 12 months? And that depends very much on not only inflation, but how the Fed responds to it. So where does the Fed sit with all this? So once again, now we're looking still at the yield curve on the right-hand panel and the real Fed funds rate relative to the estimated neutral level. And so yield curve flattening or going negative, once again, is the shaded, the US operating above potential are the shaded areas. And typically what we've seen during those periods is not only obviously the curve going flat to negative, but also Fed funds rate going above neutral, and that happened certainly back here in the early 90s, also late 1990s, early 2000s, 06, 08. So the question then is the Fed going to respond with pushing policy above neutral on a 12-month horizon? And certainly the market expectations or market pricing for Fed funds has the Fed funds moving up to around about 2%, which is essentially zero in real terms, which is close to what is estimated to be neutral, but they don't have the Fed reaching that until 2019 and particularly in 2020. So if the yield curve continued to move to flat to an inverted position, what are some of the implications? Well, now what we're looking at here, we're sort of turning this yield curve 10s minus 2s when it falls below zero, and we're trying to have a look at what happens to GDP growth in the ensuing 12 months. And that's presented on the table. So the average rate of growth of GDP in the following 12 months has been 1% versus 3% on all other occasions. So there does seem to be a significant negative impact on GDP growth, as one might expect. What about trailing EPS growth? In the following 12 months, with readings in the yield curve going flat to inverse, EPS growth has been a negative 0.9% over the following 12 months versus 9.3% on all other occasions. If we look at movement in, for example, the ISM index, it's tended to decline by about 6.7% as opposed to rising 3%. And then for the equity market itself, average returns over the following 12 months have been 5.2 versus 10.6, so basically half. So it's clearly a yield curve moving into a negative or inverted position has been negative for a number of factors, but the point is it's not actually there at the moment. It's sitting around about 0.6, which we can have a look at what that has meant in the past. So if we want to have a look at those periods where the yield curve is around about current levels but on a declining trend, and we've identified these on the chart in front of you, they're the shaded in blue periods, and they've been fairly short periods. But if we identify those, we can have a look at, for example, what has happened to EPS growth during those periods. And you can see here, period zero is the starting point of the yield curve being in the range that we've defined and on the declining trend. Generally, EPS has continued to rise. In fact, if we look at the sort of longer term in and around that period, EPS growth has continued to rise, although on a couple of occasions started to fall away after about 6 months. The equity market itself has been a bit more mixed. You've seen a few occasions where the equity market has actually declined slightly by around about 3 or 4%. But as time has gone on most occasions, bar the late 1970s and I guess to some extent the Feb 05 period, markets have generally gone reasonably stronger. Thank you.